Hello and welcome. My name is Jeffrey Kennedy and welcome back to another episode of Elliott Wave Junctures. What we're going to be looking at today, or actually what I'm going to be sharing with you today, are the 4 steps I follow whenever I'm looking for a trade. Those 4 steps are quite simple. It simply begins with pattern recognition, quality control procedures, the use of ancillary tools, and then trade plan formulation. What I'm going to be doing with today's price charts, and this is the price chart of Wynn Resorts, ticker symbol is WYNN. We're going to go through each one of these steps to kind of better explain or demonstrate exactly what I'm talking about. Now, the first step I'll do with respect to this price chart here, I'm simply looking at the advance in Wynn up from the December low. Well, the one thing I do know or the question I tend to ask in step number 1, pattern recognition, is do I see a pattern I recognize? Well, sometimes a good way to actually answer that question is I certainly see a pattern. I certainly see a pattern that's not evident, and what I mean by that is I do not see this. I do not see a 5-wave move. I see something slow and choppy with a number of overlapping waves. Moreover, I see something that is actually contained within parallel lines. Now, everyone who's a subscriber to futures junctures understands the importance of this because counter trend price action tends to be contained by parallel lines, or corrective wave patterns tend to be contained by parallel lines. So in other words, I see this advance in Wynn primarily as a counter trend move, a large corrective wave. Well, at some point we actually have to throw some labelings on it. So what I want to do next is kind of use a broad brush approach or stroke with respect to identifying the specific waves. And this is essentially what I see here with respect to, again, that price action up from the December 2011 low. And that's simply an up, down, another up. Here is a more time-consuming structure here, and then followed by another move. Okay, let's go ahead and actually apply some Elliott to this, and this is what I see: ABCX, triangle BC. Okay, now this is probably, as we move into, say, step 2, the quality control portion. This is what I see. I essentially have 7 waves up within parallel lines. I think right now the evidence is very supportive of this being a counter trend move that ultimately we can expect to be more than fully retraced. But again, let's imply that that quality control function to make sure the rules and guidelines are indeed present. Now, I'm identifying this move as a double zigzag, which means that if we actually examine this price chart more closely, each of the impulse waves, or each of the advances, i.e. waves A and C, need to subdivide into 5 waves. The counter trend moves, waves B and X, need to subdivide into, say, 3 waves or 7 waves. And as you can see here, all the substructure is indeed very present. Now, one thing is also too is interesting. If we begin to apply some Fibonacci multiples and ratios, we see that the second ABC sequence will equal a 1.382 multiple of the first one at 139.93, and then the second wave C will equal the distance traveled in the first wave C at 141.83. So essentially right around the, say, 140 handle is where we're actually encountering Fibonacci resistance in this market. Also, too, the upper trend line of the corrective price channel is also providing resistance for this market. We also have a completed wave count as we're coming into this, say, April extreme here. Moreover, that last structure, the last move out of the triangle wave B pattern, appears to be that of an ending diagonal. So the rules and guidelines of the wave principle are being supported even with, say, a closer examination of the actual substructure. Now what we can do next is let's look at some of the ancillary tools, or let's look at what else can we look at to support our Elliott wave assessment. This is our Elliott wave assessment right now. This is, as it stands, this is just simply a really good idea. Okay, I want to look at some more evidence here. Again, I think the best approach to trading and analysis is an evidence-based approach. So rarely do I actually hang my hat on a single technique or discipline. One thing is exciting, as you saw with respect to our Elliott wave interpretation. Now I look at, say, the daily price chart of Wynn, and I really do like this. The last 2 candlestick patterns in this market, well, number 1, we have a 2-candlestick reversal pattern, bearish reversal pattern. This is called a dark cloud cover pattern. Moreover, on that second candle right here, the last candle of the dark cloud cover pattern, actually formed on very big volume. So this actually argues we're going to be moving down over the next, say, 1 to 3 candles or 1 to 3 periods in this market. And I do like the hanging man that actually formed 2 days earlier right here. So we're actually seeing a couple of bearish candlestick patterns form the last 3 days, which is, again, exciting, again, somewhat supportive of the idea that we actually do indeed have that thrust out of that triangle wave B unfold or develop as an ending diagonal. Well, okay, what else can we look at? Well, let's take a look at a few things. This is our RSI indicator, and what's interesting about this, or what I see on a short-term basis, is the last few trading days marked divergence. We pushed up a bit higher in price, unconfirmed with respect to RSI, so we do have RSI divergence on the 200-minute price chart. This is another technical indicator I do look at, but rarely actually show very often. This is the continuous commodity index, or the CCI. It's a 21-period CCI, and again, the divergence I think is very evident in this price chart with respect to we're seeing prices continue to push higher, but again, unconfirmed by the by the commodity channel index, the CCI. We also have a little bit of MACD histogram weakness right here, as you can see, and so that's really about it with respect to some of the technicals that I do look at. I only look at some core technicals. I really do like RSI, I like MACD, and I do like candlesticks. You can pretty much look at anything that suits your personality, primarily is what you can do, but I like to look at other different forms of technical analysis in conjunction with the wave principle to make sure or to see if things do indeed line up with what I'm anticipating. Now in this instance right here, we can go back to this price chart, or actually maybe a price chart which is a little bit uncluttered. Let's go with this one right here. Okay, now we actually can have our trade plan put together here. Now what I mean by trade plan is, okay, I see a viable trade. That's to the short side, because as we know, the December advance from what the analysis we just performed actually concluded was that this is going to be a counter trend move. Thus the larger market is going to continue down. We're going to see when actually fall below 100. So how do we trade this? Do we just simply jump in and buy the market right now? Do we simply sell, shares or go out and buy put options? No, absolutely not. That's when we base our trading part of our trade plan on something called I call confirming price action. Okay, now what we need to see with respect to confirming price action, we can do one of two things. Whenever I have a bear market tutorial, a technique I tend to endorse, or a guideline I offer with respect to trading an ending diagonal, is wait for a break of the extreme of wave 4 of the pattern, which would be a break of that level right there. So that would be number one. If we take out this extreme right here, just a little bit above 130, which would be wave 4 of the ending diagonal, then we could simply go short with a stop at the high. If we incorporate the larger pattern here, and maybe some key or critical trend analysis work, again, something else I teach in my bear market tutorials, then we can actually wait for a break of the extreme of wave B down here. But bottom line, what that actually does is it allows us to wait for the market to commit to us before we commit to the market. It takes advantage of the analysis that we've done, but also, too, it gives us a trade plan to actually begin putting together. Where am I going to get in? Where's my initial protective stop going to be? And where am I looking for the market to go? Well, very simple. I'm going to get in initially on a break of here, maybe add to the position on a break of the extreme of wave B. Here's where my initial protective stop is, and ultimately I'll be looking for prices to fall back to below the December 2011 low. Very simple, those 4 steps. It all begins with pattern recognition, quality control procedures, the use of ancillary tools, and then putting together a trade plan formulation. Well, let's just see what kind of happened in this market. Nice move to the downside. Exactly the way price action should resolve following an ending diagonal. If you had applied our rules and guidelines for entry right here, the extreme of wave 4 of the pattern, nice entry right here, and also to a break of the wave B extreme. Very simple stuff, but I simply do these steps time and time and time again. Every time I'm looking at a price chart, I always begin with that one most very important question. Do I see a pattern I recognize? And if I do, I know what comes next. Thank you very much.